On the show today, retail participation continues to decline in Indian stocks. Why are broadcasters and cable operators in a standoff? Meta takes to subscription route for verification, and India Inc. is making fewer deals this year. This is Business Plus, your definitive edge to business and economy. Retail investors seem to be losing interest in Indian equity market as their participation in shares fell to a 34-month low in January, despite Nifty surging as much as 58% in the same period. What's more, the number of active clients on the NSE has been on a decline too, falling for 8 months in a row. Now, last month, the daily cash market average volume of non-institutional investors, which mainly comprises of retail and high net worth individuals, stood at about 22,800 crores. This was the lowest level since March of 2020 and about 61% less than the peak of February 2021. Their share as a percentage of total turnover now stands at roughly 44% compared to 66% in March of 2020. The number of active clients on NSE has also been falling month on month for the last 8 months. In January, the number of active clients was about 3.4 crore compared to 3.8 crore in June 2022. The dwindling interest of retail investors is not an anomaly, however. Foreign institutional investors have also been cutting their stake in the Indian stocks. FIIs were net sellers in Indian market in all but 2 months last year. The trend has also continued in 2023 as they have offloaded equities worth around 43,000 crores year to date. Now, domestic institutional investors, however, have provided some support. Last year, they were net buyers in all months except August and November. Year to date, they have bought stocks worth 42,600 crores. It appears like high market volatility, especially in mid and small cap, clubbed with rising fixed deposit returns following RBI's interest rate hike, have made stocks unattractive for individual investors. Shifting focus, many passionate cricket fans who were hoping to catch India's win on a Sunday at the Kotla on the telly were majorly disappointed. The standoff between the cable operators and broadcasters over pricing of channels has once again led to consumers suffering. Leading broadcasters like Disney, Star, Zee and Sony have switched off signals to cable operators as the latter refuse to roll out the new channel price hikes under the new tariff order 3.0. Now, for those who have embraced cord cutting and are unaware of the prevailing issue, the current situation has emerged because 4.5 crore cable TV families have been deprived of their daily dose of entertainment. Viewers vented their anger on social media as greedy broadcaster hashtag was trending on Twitter. But why is there a sudden disruption? Despite broadband and connected TV gaining popularity, remember, a significant chunk of population still watches satellite television services provided by last-mile cable operators who are given access to the channel by multi-system operators, popularly known as MSOs. Now, cable TV subscribers constitute 36% of the total 125 million pay TV base in India. But under the new tariff order 3.0 cleared by the regulator, Telecom Regulatory Authority of India, broadcasters hiked prices of their popular channel by 15 to 10%. Now, MSOs and cable operators alleged the price hike could be up to 60%, depending on the channel and the network, and it will be a major blow to domestic cable and satellite market. Now, cable operators are already facing a shrinking market, and price hike will lead to further erosion in user base. The All India Digital Cable Federation, the apex body of MSOs, has petitioned Kerala High Court against the NTO 3.0 and asked for relief. Broadcasters, on the other hand, are saying that the price hikes are coming after a gap of nearly 4 years. Meanwhile, regulator TRAI is caught between a rock and a hard place. But like always, it is the customers who has to bear the brunt of standoff and can only hope for a speedy resolution. Moving on, Facebook is going the Twitter route. The social network has sworn to remain free but launched a paid subscription service early last week. Meta Verified was launched on Sunday at a starting price of $11.99 a month to authenticate a user account on Facebook and Instagram. Meta subscribers will get a badge indicating their account has been verified using a government ID, extra protection against impersonation, direct access to customer support, and more visibility is in the offing, the company has said. The feature will be rolled out in Australia and New Zealand before going live in the United States and other countries. It's not clear how Meta Verified will be priced in other countries, including where users cannot afford to pay $12 a month. Now, Facebook, remember, for years has declared to be free and always free, and I'm quoting them, ditching the slogan back in 2019. The site has been collecting personal data to sell personalized ad space, but saw its revenue dwindle in 2022. The move to monetize verification follows Twitter's subscription service rolled out globally. In India, Twitter Blue has been priced at 900 rupees a month, a sum many believe is too hefty. For Meta, India is the biggest market in terms of audience size, with 239 million Facebook users and 229 million Instagram users. However, it will have to compete with Twitter Blue for paid verification services on social media. Another concern for Meta will be to deal with verification requests from dummy or fake profiles, given that Twitter's initial attempt to launch paid verification last year backfired with an embarrassing spate of fake accounts, post which the subscription service was paused and later relaunched. Facebook has its task cut out. And hinting at a slow start to the year, India Inc. made less deals in January this year compared to last year. Deal-making activity dropped 56% year-on-year in January to $2.7 billion from $6 billion in the year-ago period. What's more concerning is that 62% month-on-month decline, which was witnessed in deal values from December 2022, a report by consultancy firm Grant Thornton shows. Now, in terms of the number of deals entered, India Inc. totally inked 145 deals in January of 2023, down 41% from 224 deals in January of 2022. Meanwhile, month-on-month, the number of deals were down by about 3%. The big slump in activity was due to absence of any big-ticket deals last month. Mergers and acquisition deals valued also declined a whopping 88% year-on-year last month. Private equity investment value also declined compared to last year. However, month-on-month, it picked up by about 28%. Pharma, healthcare and biotech stood at the top in terms of overall deal values, recording 6 deals valued at $921 million, most of which was contributed by 2 big-ticket transactions. And with that, it's a wrap on this edition of Business Plus. For more incisive news analysis and cutting-edge documentaries, keep streaming News 9 Plus. Thanks for watching.